All right, we are back, and I think you can hear me now. Thanks for joining us. I see some more people popping back on. If you don't mind just commenting really quick to confirm that you can hear, I believe that everything should be working properly now. I see a few folks jumping in. We will get started right now. Again, thanks for joining us to our new free college funding workshop where you can fund your college. Awesome. Thank you so much for confirming that. Where you can fund your college and get all your money back in retirement. So let's go ahead and get started. As I was mentioning, Lifeline 360 was designed by John Dalt to, for his own needs and fund his own college tuitions, for several children that he has. So we've been able to help thousands of families with Lifeline 360 using, for college funding, using the Lifeline 360, and um, and also even fund retirement. So, but today, of course, we're going to be talking about how to use Lifeline 360 for college funding. Now, unfortunately, we really were hoping Johnny was going to be able to join us today. Unfortunately, he too had some technical difficulties. He had a really bad connection over at his office. So I did want to introduce him because I know a lot of folks are going to be joining us from Memphis this evening, as well as Jonesboro, Arkansas. We had quite a few people registering out of those areas, and Johnny is actually your local agent. He has 20 plus years of college and student service experience out of Arkansas State University in Jonesboro for many years. He has helped hundreds of parents with college enrollment for students. Hundreds of students complete their admissions application process, helping them file their FAFSA correctly, which is imperative. We're going to be talking about that here in a moment. Also been able to help them with, their career orientation classes and community college and, MBTI workshops where, he's been able to help place those students. So he is your local advisor and is so excited to help you guys out. Of course, we're going to be talking about how to save and pay for college and get all your money back in retirement. And build that plan. And these are plans even if you have a senior in high school right now and you haven't saved any money. This system's going to work. Or even if you have plenty of money, and you don't know how to use it properly, and you don't want to, risk using your retirement. This plan will work for you as well. So just to introduce Johnny, 4 generations now, four children that he's helped put through school himself, 10 grandchildren and one great grandchild already. So he's obviously, has a great passion for helping families pay for things like college. Let me just ask you a quick question. Are you concerned about the high cost of college? I'm sure you are. And if so, you're not alone, right? And if you look at some of the statistics here, it's no wonder why we're so concerned about paying for things like college, because if you look since 1978, college tuition has increased over 1,200%. And compared to things like the medical care at 600%, and even housing at over 300%, this is just crazy. Yes, you're absolutely right. We are all concerned. And there's no question about why, right? Not only are we seeing that cost go up, but the biggest problem is the fact that we see all these costs going up, but income hasn't increased. You can see here by the line represented in blue that our income has pretty much stayed the same. And based on how expensive things are, we would have expected our income to increase 651%, but that just isn't the case. We continue to see these articles like one written by Forbes here recently where college, tuition is rising twice the rate of inflation, while students are learning at home even during the pandemic. This was written during the pandemic. So why doesn't the government do something about that? And here's what's so crazy is that this is something that I found out recently in my research. I thought that taxes were the highest income tool for the government, and it's not. You can see here, this was recent statistics showing that student loan debt accounts for about a third of all the federal government's financial assets. So, they have really no interest in eliminating this debt that's out there because they just earn too much from it. So college is expensive, and it might be more expensive than you even think. And it's only going to get more expensive. So take a look at some of the average costs here. Again, these are statistics are available right now. You can see that the average cost for an in-state 4-year tuition is $25,000 a year. So you're looking at over 100,000 for a 4-year degree. Out of state is even more. Students can pay upward of 53,000 per year. Spending over 200,000 in a 4-year degree. And when I mentioned that part about it could only get more expensive, is that you look at a recent statistic, 60% of students who were looking to obtain a 4-year degree end up having to spend 6 years in school. So, really the average is $155,000. So if you look at that, let's say you're only spending $100,000 for a 4-year degree, and you look at that over a 10-year period at 6%, you're going to spend almost $1,200 a month. That's a mortgage payment. That's a lot of money. So why do we even consider going to college? So you can look at the statistics here. It still pays, right? So if you look at somebody with a 4-year degree or even a master's degree, your income potential is still significantly higher than not going to school. So you want to set, your children out right. And of course, there is still very good reason to get a 4-year degree or even better. So what about financial aid, you might ask? And it's true, not everybody pays the same for college. Very similar to taxes, right? Not everyone pays the same in taxes. So how much, how much you pay for based on your FAFSA and your expected family EFC, for all federal aid and CSS profile for non-federal aid. So billions of dollars are actually available through CSS profile. Parents, often don't realize this. So, and these are not available to just the FAFSA only. So many colleges actually require that CSS profile. So I included the links here, and don't worry, you can always message us and we'll share this so you can get back to this later. So to give you an idea of how that EFC works, let's take a look at a few examples here. So first, I'm just using a EFC calculator. Of course, this takes dozens of different metrics to calculate. So they look at things like your income, they're going to look at things like your assets, and of course many other factors. But let's just take a family that doesn't have any assets, and let's take a family that has a dual income. They're making $100,000 of income. Their EFC, your expected family contribution is $16,366 there. Now let's take another example. A family of two parents in a household, 2 incomes, that's making $150,000 a year. Again, no assets. So we're not considering for those folks who own a home or those folks who have some money in savings, or in the market maybe. Again, we're not considering all that. We're just considering a household that makes $150,000. Your expected contribution as a family is $33,000 toward your kids' tuition. And then one last example here, $200,000. Your family contribution is now expected to be $50,000, right? And you don't know this until your kids are actually applying for school. So let's take a look at some recent tuitions. If I just pick 3 random private colleges and then 3 random public. I know some of the folks out there are joining us from Texas, so we got a Texas school. We got some folks joining us from California. We got a California school. So just let's look at the sticker price. So this is what you're expected to pay for Duke University, $77,000. For Rice, $67,000. For Stanford, $70,000. These are annual cost, annual sticker price. Now, you might think that you're saving money going to a state school, and of course, on the sticker value, yeah, you might be right. University of Arizona in Tucson, $30,000. University of California, Berkeley, 37,000. Michigan, Ann Arbor, 31,000. But okay, now let's take your family contribution. So if you look at Duke University, your EFC contribution with 33,000, once you subtract that, they're going to expect you to pay $44,000 here. At Rice, they're going to expect you to pay 34. At Stanford University, they're going to expect you to pay 44. And you're not going to get any aid from Arizona. No love from them. You're not going to get any love either from Michigan, because guess what? Your expected amount is higher than their tuition. So, taking a look, a lot of folks may not realize that you might actually, be able to go to some of these private schools for about the same as you would a public school. Why? Because picking the right school can make all the difference. For instance, looking at this last year, for instance, Duke University, for all those who applied and were accepted, they met 100% of the need to all those that needed, and 100% of their need was fully met. Rice, very close as well. Rice, they met 100% of all those students that needed financial aid. They met, and they met 98% of that. Stanford, very close. 100%. The folks that applied got some kind of financial aid, and they met 90% of it, unlike some of these public schools. So if your EFC is lower, then even if you apply for financial aid, you can see here only 13% was actually met, was actually fully met. Berkeley, only 29% was actually fully met. University, Michigan, Ann Arbor, yeah, I hear some comments out there. Wow, you're absolutely right. A lot of folks don't realize, picking the right school makes all the difference as well. So, what does that actually look like in terms of out-of-pocket cost? For somebody that has an EFC of 33,000, you can end up going to Duke, Rice, or Stanford for the same price. Why? Because not only are they going to expect you to pay that already based on your EFC, but you might not even get financial aid, or as much as you need. Where if you go to Duke University, or Rice University, or even just picking the right school by working with us, you're not only going to get to go to some of these schools for, if not the same price, but maybe even cheaper after financial aid. So, not only how you pay for college, but even where you go to college can make a huge difference. Now, I know some of you might be saying, I have an exceptionally gifted student, and, we plan on getting scholarships, so it won't be that expensive. Well, here's the truth. The truth is, if you look at the statistics, private scholarships only make up 1% of all the free money awarded. Most of the scholarships come from the schools that I was mentioning, the type of schools like, Duke University, Rice University, and many other schools that actually provide scholarships directly from the school through their needs process. So can you really count on scholarships? Well, you rarely can, because a lot of these are need-based and they're contingent on, certain stipulations that you have to maintain. That might be maintaining a high GPA or specific SAT scores or other test scores that you can easily lose that money. So it's very difficult to count on that. And worst of all, the timing is horrible right now. You can constantly see, how our Americans aren't doing well saving for retirement, and it's only getting worse. So, you don't want to tap in to your retirement funds. So fortunately, there is a better solution. How you pay for college is 10 times more important than how much you pay or where you go to school. But let me just share, typically what people do, they've got two approaches. There's kind of the saver approach, and these are folks who utilize tools like just the cash flow they have from maybe, your income or your business income, your savings, utilizing savings that you have in a bank account. Maybe you're using a 529 or a prepaid, or maybe you're using a trust. Second, better, right? You might be able to take advantage of Stanford loans. You're going into debt for that, right? or too many parents end up going with this Parent Plus loans where, where most parents, statistic recently said that 40% of parents, are going broke after the second year and their kids have to drop off, or, even worse, private college loans with high interest rates or taking equity out of your home. So here's kind of what that looks like. You save and then you have to spend it, and then you save, you have to spend it, and you're really not getting ahead. Or you're borrowing, you're going into debt and you're using it, you're going into debt and you're using it, and you're just getting further and further. So and the problem with either of these systems is that there's no money for retirement, right? You're either using your money for retirement or you're borrowing, you're going backwards, and you're spending a lot of time, a lot of money rather, in interest, and a lot of time paying that back. So, financing every major expense, you're either going to pay a lot of interest, or you're going to give up the ability to earn interest on the money that you're spending. So you have to consider the opportunity cost. So take a look at this, $122,000 loan for a 4-year degree, over 10 years at 6%, you're going to end up paying $40,000 in interest alone. So that's a $1,300 payment, $40,000 in interest. You're going to end up spending over $200,000 during the cost of that loan. So let me give you an example here. Let's pretend you took that same amount of money, that $102,000, and you invested it in a vehicle that was giving you a 6% return in 10 years. You're going to have made $99,000 on that money over 10 years, giving you a balance of $218,000. You're giving up that ability by either going into debt and paying that back to the bank, or trying to save that money and then just spending it right away. So our solution looks more like this. Our solution is put into a plan that actually gives you the ability to earn and then use that earning to fund things like college, and then continue earning along the way. So, let me ask you a question out there. Would you say your income is common or uncommon? So hopefully you guys can just shoot me a comment there if you can. Would you say your income is common? Do you think you have a common income, or do you think you have uncommon income? So I'll let you guys take a look at that. And so let me go ahead and share this while those comments are coming in. So just to give you an idea, you only have to make over $35,000 a year between, if you have two incomes coming in, or maybe you even have 3 incomes coming in, and you're in the top 50% of income earners in the US. If you're above 80,000, you're in the top 25%. If you're, yeah, I've got some comments out there. If you're making over 130,000, then you're in the top 10%. If you're making over 180,000, you're in the top 5%. So you may actually, a lot of you may actually be in that uncommon category. So if you have an uncommon income, up here, even in above 80,000, then you may need an uncommon way to fund college. So let me have you consider this. Okay, let's imagine that a bank is going to pay you 7% on savings. Now, you and I both know that doesn't exist, but let's just pretend for a second that a bank pays you 7% on the money that you leave on, in your savings account. Now we both know they only pay you, less than 0.5%, but let's pretend for a second. And then let's also pretend that you from the bank at 5%. So knowing that, would you use your savings in cash, or would you borrow at 5%? Now, of course, you would borrow at 5% and leave your money earning 7%, right? That is exactly how a Life Plan 360 works. We have a new plan and a new way to pay for college. You're able and then get all your money back in retirement. And this is as simple as earning that positive spread on your money. All you need to do is earn a greater average return on your money over time and borrow at a lower rate. Even if you have a senior in high school and no money saved, we've been able to work with hundreds of families to build these plans. And again, to show you what that looks like, all you need is that positive spread. As long as you're able build one of these plans with us and you're earning a greater interest rate than you're borrowing, you have a positive spread on your total earnings. So let's review. We've talked about the opportunity cost. If you finance every major purchase, you're either paying interest or you're giving up the ability to earn interest. So you must consider that cost and the opportunity cost. So let's talk about different ways that we can help you accomplish this. So there are 4 ways ultimately. So one, you can use real estate. You can access equity in a home that you own. Now, the problem with real estate that it's not FAFSA free. So when you apply for FAFSA application, they're going to penalize you. That's going to count as what they expect you to use. And of course, interest rates are changing. Those can go up over time. Another option number 2, is using the stock market and using margin loans. But the problem with this is, of course, your rate of return can be variable. You can also lose money, and that's we definitely don't want you to take any losses. But not only that, it's also not FAFSA free. So any money you have in the market can be penalized, and you would be expected to use that toward your college tuition. Now, one other option, cryptocurrency, really exciting. You guys have probably seen cryptocurrency growing and growing over these last few years. Unfortunately, it is also not FAFSA free, and you can also take losses in cryptocurrency. And last but not least, you can use insurance companies, the cash value with insurance companies. See, now with these insurance companies, luckily, it's FAFSA free and you cannot take any losses. It's also tax free, and they provide fixed rates not only on your return, but they also provide fixed rates on secured loans, and that's where that ability to earn a positive spread comes from. So let's see what that looks like. And before we do, I don't want you to just take my word for it. There is plenty of literature. Even Tony Robbins wrote a book recently, Money Mastering the Game, where he spoke about all the wealthy individuals that he's worked with, and over that time in chapter 5, he's talked about how the wealthy have been using insurance companies to build wealth and fund not only businesses, but things like college funding, of course, and real estate. Not only Robbins and the wealthy people that he knows, but even if you go to the FDIC website, banks like Wells Fargo, banks like Bank of America, and many other banks are utilizing insurance companies as part of their asset. For instance, Wells Fargo alone, is using 17, billion. Bank of America, 19 billion. JP Morgan Chase, 10 billion. US Bank, over 5 billion in life insurance companies, because they offer these guarantees. Other companies that use these plans, Amway, as you can see, we've got over 50 different companies here. Office Depot, Pfizer, Starbucks, Nestle, Monsanto, CVS, many companies use these same systems. Not just financial institutions, but many other companies use A+ rated insurance companies to use as wealth building tools. So of course, this is different than typical life insurance, right? These are not designed for maximum insurance. Some of you might have worked with agents, and I'll tell you right now, not all insurance agents are created equally, just like not all doctors or lawyers right? If you're having a surgery, I'm sure you're going to want to pick the best doctor, just like if you want to have a financial plan design, you want to pick the best advisor for you. And not all of them are designed for maximum, insurance. So some are specifically designed for maximum cash value, and that's what we do. So we're able to build plans here. For instance, this is 40-year-old male, where we're able to build income stream of $2.2 million after he contributed starting at age 40. Another plan here where one of our clients was able to put a lump sum in, making contributions over several years here, and able to produce over a $3 million income, where you're able to utilize that cash as collateral actually, and pay for things like college. So you're able to get consistent growth even if you just do a lump sum in these plans. So, by using insurance companies, they're contractually obligated to give you a guarantee and the ability to borrow. So let me kind of reemphasize this, right? That you get guaranteed returns. They offer dividends, and best of all, there's no application process, right? You're not having to go through FAFSA. You're not having to apply for a HELOC or a line of credit, right? There's no credit check. There's no restructured payments either, right? So if you go and get a loan, they're going to expect you to make monthly payments, and you're going to be, accumulating interest that entire time. If you choose not to pay back any loans you take against an insurance company, since it's collateralized, there are no structured payment, right? You could pay that back upon death if you'd like, against your death benefit, and that's how you can get all your money back in retirement. So there's a wrong way and a right way to set up life insurance for maximum cash value. So I want to show you an example. Let's take a look at an indexed universal plan that a lot of folks are touting about out there. Unfortunately, those don't give you guarantees. And if you were to take an average yield of 4 to 5%, this is what it might look like if you're funding it properly. You might end up being less than 500,000 after investing, from age 40 for over 20 years, versus a typical whole life might generate, some cash value. But nothing like a high cash value insurance policy that can generate as much income as $3 million over your lifetime. So to give you an example there. So why isn't everyone doing this, you might ask, right? So why, if these plans are so great, why isn't everyone doing this? Why hasn't my financial advisor showing me this? And it's quite simple. A higher death benefit on a life insurance policy equals high commission. Just like an advisor who wants you to put your money in the market, high fees are going to equal high commission for them. So regardless if you're making money or not, they're earning high commissions. And that's why not all agents are created equal. So again, to take a look at what this would look like, 4% fixed loan with a 6% average, as long as you have that positive spread, you're going to be making money. So it's not just for college. You can use these plans for tax-free retirement, emergency funds, weddings, real estate investing. A lot of folks using these for real estate investing, business funding, vacations, and any large purchases. So the advantages to insurance is it's sheltered from ESE, like I mentioned, right? If you want that FAFSA free, where they don't penalize you like money that you have in real estate or money that you have in, your retirement funds. It's a fixed rate of return. You get tax deferred growth, right? You're not paying taxes on it. It's tax-free access. You can access this without paying taxes, unlike a 401k or your IRA. If you wanted to dip into that for some catastrophic event, you're going to get penalized, 10% and have to pay taxes on it. There's no losses in the market, and you're going to get collateralized loan. Again, reemphasizing unstructured loan payment. So no application fee, no credit check, and a positive spread on your money, even when you're borrowing. So a death benefit is also passed on probate-free and tax-free. A lot of folks don't realize this. They think that, well, I want to pay off my house so I can pass it on to my kids. Well, a lot of people don't realize that it's not going to go to your kids, unless you've already set up a trust or a life insurance policy through us. Then that's actually going to go to probate. The state is going to take over all of your assets, including your house that might be paid off for, right? You spent your whole life trying to build a savings account, retirement, and pay off your house, all to have that just go to the state, right? Your children not be able to take advantage of that or use any of that. Where our plan is going to give you probate free and tax free inheritance for your children. So let me give you a word of caution. You do a couple of things with this information. Definitely I encourage you to use these plans, whether you choose to use us or not. But a word of caution, not all insurance companies offer fixed rate of returns. Also, not all insurance companies offer 4% fixed loans. And not all insurance companies allow for collateralized loans either. And not all insurance companies are A plus rated and have been in business for over 100 years and providing dividends for over 100 years. And not all insurance companies offer these high cash value policies. So make sure you do your due diligence. Make sure you do your research. And if you decide to work with anybody else out there, that you take a look at these to ensure that they're providing you the absolute best plan. So keep in mind, this is not just for college savings. You can use this for debt elimination, retirement planning, fast with your FAFSA filing, your your CSS profile, scholarship money, your TI and career coaching sessions with Johnny, as well as in SAT. So I hope this information was helpful. Thank you so much for those who have joined us today. And also, please message us here at LifePlan 360 Advisor. I'm also going to go ahead and provide Johnny's information here. Johnny, you can go to, you can email him at am0305@gmail.com. He is your local advisor if you're in the Jonesboro or Memphis area. He does service. He offices out of both of those locations. Is here to service you. Please take down his number as well, 870-253-2753. And again, we definitely appreciate you guys all joining us. I just wanted to say thanks and say hi out there again. We will be recording this and leaving it up here live. If you need to catch that number again, or if you needed to go back and get any of the information that we shared, please feel free to go back and watch the recording. And if you have any questions, we're going to be here, Johnny and I and some of our staff members, we're going to be here on Facebook. Please feel free to comment. Feel free to message us for any questions. And if you'd like to go ahead and set up, we're actually going to be setting up time in the Jonesboro and Memphis area here in the next few days. We're going to have 10 spots available. Please go ahead and message us so you can reserve those spots with Johnny right away. He can actually only take so many clients at one time. It is a lengthy process, so please reserve your spot if you are interested. And with that, saying hi to Johnny. Hopefully you can see us out there, and to all those out there in Facebook Live, thank you so much for joining us, and we'll catch you next time. Hope you guys have a good evening, and we'll talk to you soon. Bye now.